Welcome back. You're watching IndianOpen right here on BloombergQuint Live. Asia is a pocket. Remember, we've got the Lunar Year celebration, so you've got China and Hong Kong, which is shut for trade. Japan is the only market that you can get a gauge of, so that's down about 1%. And the only other way that you can get a sense of what China could likely do is via the FTSE China A50 index. That's the only one that's open for trade because, you know, the rest of the market shut. This is a group of 50 stocks from the Shanghai Composite as well as the Shenzhen index. This is A shares listed in renminbi, so not dollar denominated or not foreign currency denominated shares, and you've seen how that index has tumbled 6% in the last few days.
Yeah, there's a Bloomberg story around that as well, and it'll be interesting to see how the Chinese markets open on come Monday, but the rest of the Asian pack not looking all that strong, and difficult to gauge the extent of the impact they've been for now.
Yep, let's also get in a sense of what's been happening in the futures and options space. Navneet joins us for that. Navneet, good morning.
Good morning to both of you. Well, there were clear signs of fresh shorting coming in for the Nifty as well as Bank Nifty futures as both the indices fell in yesterday's session. In fact, Nifty closed below its 50-day moving average. So rollovers have started to pick up 19% for Nifty, but across the series, Nifty open interest was up about 3%. I think more shorting was seen for Bank Nifty, which so far has been underperforming Nifty. So across the series, open interest for Bank Nifty futures was up about 10%, and you did see the rollovers coming in at about 24. Remember, Bank Nifty for the longest time has been trading below its 50-day moving average. Volatility index surged, and this was primarily due to the global factors because of coronavirus. So India VIX closed at levels of 17.18, and if you look at the options picture as well, there was more call writing which came into the system. As a result of that, you did see the Nifty PCR across all series falling to levels of about 1.1. In terms of distribution for this monthly expiry now on Thursday, 12,000 put and the 12,500 call. Actually, no, it's the base has moved lower after yesterday's session. So 12,200 strike is the one which is sitting with maximum open interest. So 12,000 will become a good support for the market, and 12,200 on the upside is something which the traders will be watching out. Yesterday, of course, 12,200 strike added nearly 30 lakh shares, and put writers of that strike ran for cover. Very quickly, then on the stock futures side, there were a lot of stocks buzzing even in a weak market. So Cholamandalam Investment, of course, the QIP news is out now. It was up 1.7. Across the series, open interest surged 36%. As after results, Dr. Reddy's touched its 52-week high. Long positions were seen there as well. And Escorts has had a good run. This month itself, it's up about 18%. Longs continued here as well. And HPCL was the one where fresh shorting came in on the futures side. And heavy shorting seen on index futures from FIs. As you can see, nearly 16,000 contracts were added, while they unwound nearly 7,700 contracts. With that, it's back to you guys.
Thanks for that, Navneet. Well, let's move on. Demand for affordable housing remains robust, according to Keki Mistry, the Vice Chairman and CEO of the country's largest mortgage lender, HDFC. You're speaking to Advaitra after the company's third quarter earnings. Let's listen into what he has to say.
Has always been on individual loans. We have consistently over the last 6 quarters told our investors that we would be focusing more on individual loans, and we continue to remain cautious on non-individual loans. Individual loans AUM growth has been 16%, non-individual AUM growth has been 6%, giving us overall AUM growth of 14%. So that's the broad macro. If you look at the average loan size for individual loans, it used for, if you look at only the first quarter in isolation, it was 27,70,000 rupees. Second quarter was 26,60,000 rupees, and third quarter saw a further reduction to 26,50,000 rupees. So the growth has come largely on volume, on number of applications, rather than on increase in the average loan amount. And it also shows that demand for high-priced apartments, the expensive apartments, has slowed down. But in the affordable housing segment, the demand continues to remain good.
So in terms of proportions in the individual loan book, the premium or the high-ticket loans, what percentage of the loan?
Relatively very small now.
Okay.
So if you look at the affordable housing loans, in value terms, it is now 18% of our disbursements, and in number terms, it's as much as 36% of our disbursements. So 36% of the loans we did in the current year were to customers who would fall within the economically weaker section or in the lower income category.
So post the collapse of the infrastructure leasing and financial services group in September 2018, there's a lot of questions that were thrown about housing finance companies. I understand that HDFC did not have an asset liability mismanagement or mismatch that many other companies did. But I just wanted to understand, how do you see the environment? There's a lot of talk that there could be defaults in the real estate sector by developers. Have you seen that happen, and what is your outlook? How do you see the credit situation, at least from
my sense is
construction?
that if you look at the NBFC sector or the housing finance sector, as you put it, in the early part when the ILFS crisis happened, there were two issues. One was liquidity. Liquidity was tight in those days, and the other was risk averseness. Today, liquidity is not an issue. The RBI has very rightly, very correctly infused huge amount of liquidity in the system. So there is no concern as far as liquidity goes. Risk averseness definitely has set in. So there is a reluctance on the part of banks and lending institutions to give money to every NBFC. So NBFCs are now clearly categorized into very strong, not so strong, weak, and so on and so forth. And the weaker and the not so strong NBFCs are finding it very difficult to raise money. This is more a function of risk averseness. Default you are talking about, look, default is always going to be a risk. Non-performing loans is always going to be a risk. But what you must understand is that financing of real estate is very different from financing for a car or financing for a vehicle or financing an industrial project, because the security value of the loan is always the real estate. And whatever be the conditions, real estate has a value. So whilst technically loans can become non-performing loans and, as you said, delay in making payments and defaults, risks of major losses in the real estate sector to that extent are very limited.
In terms of HDFC strategy in the past year or in the last 6 months, what has the strategy been in terms of your existing construction projects that you're funding?
Our strategy has been to grow the individual business, to be very cautious with non-individual business, which is reflected in the fact that if you were to look at it on a balance sheet basis today, individual loans constitute 76% of our total loans, construction finance constitutes 11%, lease rental discounting constitutes 8%, and corporate loans constitute 5%. This is on a balance sheet basis. If you were to look at this number incrementally for the third quarter, only for the third quarter, individual loans constitute 81% of the growth, non-individual loans constitute 19% of the growth.
So that's been reducing over time, the non-individual component.
Yeah, if you were to look at it for the 9-month period as a whole, then it would be 90% individual loans and 10% non-individual loans. So clearly over the last couple of years, we've seen that the focus has largely been on individual loans.
All right, that's HDFC for you. And the numbers looked okay, I think in line with estimates, even if the bottom line showed that, or the numbers showed a bit of a bump up because of the Growth Finance deal. Mayuresh Joshi, Head of Equity Research at William O'Neill, India, joining us on the show. Mayuresh, good having you as always. Thanks for joining in. Since we're on the topic of HDFC, let's first start with that. We'll get to the overall markets in a bit. Par for the course, numbers from both the group companies, which is the bank and HDFC,
Sure.
somehow the last few days haven't been particularly conducive for the stock prices. Do you view these numbers and the dip as opportunities to buy, or is it unpredictable right now because of the overall market view?
So morning, Neeraj, morning, Navina. No, I think the numbers were in line, so you're absolutely right. Nothing exceptional about it, assuming the business environment and the conditions that we are going through. Again, I think the asset size that HDFC has, the kind of audience that it caters to, as Mr. Mistry was pointing out, it's very, very retail-centric at this point of time. The underwriting has become even more stringent, even within the retail portfolio itself. And I think all the NBFC stroke banks are chasing high-quality retail assets at the same time. So I think you've got a very small pie at this point of time that banks and NBFCs ideally are chasing. And therefore, I think valuations come to the fore because you're not growing at the pace that you are. But at least I think you're a little bit better off than the others who are probably very, very dicey at this point of time or volatile in terms of quality of earnings. So I think we continue holding this in our portfolios. I think it's a stable stock. I think it's not a stock which will give you humongous returns in a day, in a week, in a month. But it's one number or one company which will probably give you a consistent earnings trajectory. And I think I can sleep very, very peacefully with that stock in my portfolio.
Let's talk about the other private banks so far that have reported numbers, and all of them strong operational performance with regards to, except for Axis Bank. For Kotak Bank, there was deposit growth, miss, loan book growth remains strong across the board except for Kotak. In light of all of these parameters, including slippages, provisions that most of these banks have taken, which according to you has done decently enough this quarter?
So I think everybody had a relatively...
Some pluses and some minuses.
Exactly. So I think the whole point here is now looking at the future landscape in terms of how the environment probably is expected to shape up. Now the large belief for the banking system as a whole was that advances were going to come off, and they have. The second element obviously is that the slippage component has inched up marginally. I mean, quite substantially for a few PSU banks. But largely I think for the larger private ones, I think they have inched up marginally because I think the stressed assets which came to the fore in the last quarter, I think that probably mandated these banks to provide. But the good element for at least the larger private sector banks selectively here again is that their capital adequacy ratios remain extremely strong. So I think tier 1 ratios are adequately placed. So in terms of a bounce back, because liquidity is a flush in the system at this point of time, I think as the demand comes back, possibly in the next quarter or so, I think these banks are better placed in terms of the tier 1 ratios and the balance sheet expansion that they can do. PCRs are very well provided for. So whether it's private or public, I think the PCR ratio is quite there. So I think the asset quality risk in terms of the watch list or the SMA2 list, as we've seen it for most bankers, I think they probably are covered to a large extent. So I think the dual effect is how loan growth is expected to pan up and how deposit growth is expected to pan up. I think in lieu of all the parameters that we probably put through, bottom line growth because of the deferred tax asset adjustments, I think, has been better. But I think if you look at the operational performance, I think ICICI still has stood the test of time. Yes, there has been an increase in the overall slippage pie, but my entire thesis is that I think a large part of the recognition is done. And they're very, very, adequately placed off in terms of a huge kickoff in terms of all these parameters that can actually support their earnings momentum. So out of all the results, probably ICICI Bank still ranks right there at the top.
All right. I'd like to come to you on SBI and what your expectation is from that one, but in a bit, because we need to go across to our research team now to talk about some bigger numbers that are coming out today. Maruti, the big one from the Autopack, reports its numbers. Is it going to be any different from what we've seen out of the last few quarters? Forum's going to highlight that for us and some other stocks in news. But I'll come to you, Darshan, first.
Yeah, so some of the stocks that came out with numbers after market hours yesterday. The first one was Navin Fluorine. Revenues up 11%, EBITDA up 26%, a strong EBITDA margin of 25% versus 22% this time around. It was the specialty business that did well, that grew 33%. The CRAMS business was slightly muted. It was down 5%. Torrent Pharma, while the financials were in line with estimates, I think the core business was extremely weak for the company. Higher other income and lower tax boosted profits this time around. There was also a one-off that actually impacted the financials, but the core business in India as well as the US markets was rather weak for Torrent. The other one is United Spirits, severe margin improvement that was seen on the back of lower employee cost and other expenses. Volumes in the P&A segment were much better. The popular volumes remained slightly subdued and gross margins were slightly under pressure. V2 Retail, strong revenues were down 9%, profit down 12%, EBITDA was up 10%, and that was on account of Ind AS, but overall not the best set of numbers. Maruti Suzuki will hike prices in a lot of their products from January 27. And La Opala, there was big block deals that happened yesterday. HDFC Mutual Fund bought in 45 lakh shares in the company. Westbridge as well as Jwalamukhi were the sellers here.
All right, Darshan, thanks for that. And Maruti, what are we expecting for them?
Yeah, well, so good set of numbers are expected from Maruti this time around. After reporting a degrowth in net profit for more than 3 quarters, this quarter is going to be a relief for Maruti. So we see revenues going up by 9% at about 21,437 crore. Net profit is expected to increase by 13.3% at about 1,687 crore. EBITDA seen up by 12.8%, and margin is expected to expand to 10.2% versus 9.8% a year ago. So revenue is expected to increase on account of increase in sales volume. So if you see, the company saw a marginal uptick in sales volume by about 2% in Q3. So this reflects some kind of stabilization for the company after a steep decline or even production cuts taken by them earlier. Other than that, higher average selling prices on account of introduction of new safety regulations for entry-level cars is expected to be a positive for the company. Migration of petrol portfolio to BS6 is something which is going to work well for them. EBITDA is expected to increase on account of increase in revenue. Margins are expected to expand on account of operating leverage benefits seen this time around. This is partly offset by higher discounts offered by the company. Now, other than that, if you see, prices of some of the major commodities like steel, aluminium, copper and rubber have declined in the last 2 quarters. So this is going to work well for the gross margins of the company this time around. And it is even expected to accrue more benefits over next 1 to 2 quarters going forward if the prices sustain sustain at these levels.
All right, guys, thanks very much
Yeah.
for that. Mayuresh, quick take on Maruti and the fact that you are actually likely to see volumes go up. Do you feel that this could be somewhat a bottom that's being put into place for Maruti?
Let's hope so, Devina. So I think if they deliver as per market expectations, and largely if you probably see even the December numbers, I think the December numbers on a month-on-month basis have started normalizing. Even the inventory levels for Maruti have come back to normal levels of almost 24, 25 odd days. The new launches that they've got, and when you probably talk about BS6, the petrol variants, are close to 74, 75 odd percent. So to that extent, again, I think the kind of hit that Maruti was taking in the previous quarters, probably I think that pain is going away. So if history is to be believed, I think if they're able to deliver in the next few quarters with their market position and the kind of launches, ensuring that the sales velocity falls in place along with realization growth, because there will be a discounting part as far as taking off the BS4 inventory is concerned. But I think markets have largely factored that in for this quarter and the next. So I think it's all about FY21, FY22 numbers. And if they come back on their normalized trajectory, yes, I think that is one stock that investors can bet on within the auto space.
Did you like what Interglobe Aviation has done in the quarter?
I'm quite okay, very frankly. So the only issue,
also the fact that crude has come off.
Yeah, so I think it's more sentimental at that point of time with that aspect. But if you probably look at the core numbers, right, there's always a differentiation that aviation companies put out in terms of their reported numbers on their presentations. So there is a CASK element which includes fuel, and there is a CASK element which excludes fuel. So I think if you probably take the fuel component out, I think the optimization on cost has largely got mitigated because of issues related to A320, so the maintenance costs have gone higher. The other element in terms of higher wage or the employee costs, because they've taken pilots to probably run through all the planes that they've probably taken in terms of additional routes and so on and so forth. So you've got those added elements of cost which have added onto their balance sheet. And the revenue per available seat kilometers has not improved substantially. So yeah, I think it's largely now a very constrained market, right? No new players are expected to come in. There is expectations that the new aviation policy might open out new routes for these players. But again, I think all these mitigating issues that you probably got, the A320s for Interglobe, what happens in that part, SpiceJet similarly, I think the 737s, the issues faced on that part, and what point of time will the compensation come through, if any. I think all those time lags along with the elements of added costs add on to the cost pressure. So yeah, I think maybe sentimental plays, but structurally I think there is still time.
Okay. Let's also get in a sense as to what kind of trades can one take this morning. Brijesh Bhatia, head of research at Dealmoney Securities, is joining us right now on the show. Brijesh, good morning to you. The SGX is suggesting that we might have a slightly negative open as we set up for trade this morning. At these levels, would you be long or short on the index?
Good morning, Devina. I think I will continue with my short momentum in the market, because we have consistently seen that even at a slightly bounce, we have seen a huge selling pressure coming in the markets, especially in the large caps. And if you look at the momentum in the Nifty and Bank Nifty, both are slow and steady dragging down. And compared to the outperformance against the mid cap has seen a strong comeback, and money has been shifted from large cap to now mid caps. I think from a trading point of view, I would continue to short Bank Nifty over Nifty, because still the Nifty Bank to Bank Nifty ratios continue to see downside momentum, which means that Bank Nifty underperformance would continue over the Nifty. So one can take a short bet on Bank Nifty at around 30,879 future close. Looking for the target of around 30,324 on the downside, and stop loss can be placed at around 31,089.
Brijesh, just a follow-up there. You were amongst the earlier ones to identify this short on the Nifty Bank. Are these fleeting levels, or would you believe the downsides could be even more on the Bank Nifty?
I think, yeah, most downside to around 29,500 is the levels which I'm eyeing on the Bank Nifty, where some buying could be expected. But as of now, still a bearish momentum would continue on the Bank Nifty. And I think Nifty around 11,970, 11,990 spot stands out to be very, very strong support as of now. So I will wait for those levels to test. And in case we find a reversal around those levels, might see a good upside again. So still, if you look at the trading point of view or on the downside, Bank Nifty is still stem on the downside against the Nifty. So that's the reason I'm looking for a bet on Bank Nifty shorts over the Nifty.
Okay. Hemen Kapadia of KRChoksey is also joining us right now on the show. Hemen, good morning to you. Let's talk about your view on the indices, the Nifty as well as the Nifty Bank.
A very good morning to you, Devina. I guess a gap down opening, but I think it still means the same thing we spoke earlier, Devina. Gap which is still open, partially filled. This gap gets covered up around 12,000 levels, Devina. So I would wait for that. Yeah, the market looks weak. I think there's no rocket science about that, but I would prefer to buy around 12,000. I would not trade the Nifty right now. Yes, there is weakness. The Bank Nifty is dragging it down. That's very clear. But yeah, I'll still wait for 12,000 to go long, Devina.
Okay. Wait for 12,000 to go long. Let's also talk about individual stocks then. Hemen, I'll keep it with you. What are the stocks you're recommending this morning?
I think everything looks a bit shaky. So I have a sell call on Tata Chemicals. Sell Tata Chemicals at around 750. Stop loss 754. Target 742. We're seeing a small distribution pattern happen, Devina. If you look at the intraday charts, the hourly, 2 hourly, 3 hourly, they've given crossover sells. So a decline seems to be around the corner. The second stock, which is also a sell, intraday point of view, is Amara Raja. Same logic applies, Devina. We're tired in the sense the stock has had a run up. The stock is tired. We've given a downward key reversal on the daily chart yesterday. There's some negative divergence. Plus, once again, the intraday charts show a topish rounding top. A rounding top is basically a bearish formation. And we're seeing negative divergence also on the intraday charts with a crossover sell. So sell on Amara Raja at 804, stop loss 809, target 794 intraday.
Okay. Two stocks there from Hemen, both on the short side. Brijesh, what are you doing?
I'm looking for one long and one short. So let's start with the short first. So if you look at the metals pack yesterday, seen some cool off after a strong rally. So I would take a short bet on National Aluminium at around 45.50 on the future side, keeping a target of 43, and stop loss would be placed at 46.50 for a couple of reasons. First, if you look at the stock, it has given a breakout of around 200 as average, and this unsustainable move has dragged price on the lower price. Second, if you look at the RSI, we have seen negative divergence on RSI on National Aluminium. So this is the couple of strong reasons which think that prices might slightly correct towards 43. Still, we think metals is not back for a long-term short, but it's purely a momentum-based, and I think at around lower levels, one can again look for a buy in metals index. My second is the long bet on LTI L&T Infotech. If you look at the stock, has broken out of its descending triangle formation on the higher side. The triangle, if I look at the height of the triangle, it's around 500 points, and it has given a breakout of around 1750, 1780. So at around 1945, still take a long bet for the target of around 2100, giving a stop loss of 1892 now.
Okay. Those are some stock ideas you need to keep in mind before we set in for trade today. On to a special segment, Bloomberg Edge, where Yash Bhatia tells us about a pattern that the Bloomberg terminal has thrown up on a stock today. Good morning, Yash. What's the stock?
Good morning, Devina. So we're looking at a Nippon India Life Asset Management, and after 2 successive days of strong gains coming in for the stock, it has managed to take out a crucial level of the trender mark. The trender, as you know, is a proprietary Bloomberg indicator, and it uses the average true range for the purpose of calculation. It helps generate a buy or a sell signal, and also helps you manage your stop loss. How do you interpret it? You go long when the trender line changes its color from red to green, and you go short when it changes its color from green to red. When does this happen? Well, the color change happens when the price closes above the trender mark. Now, that is what we've seen, at least as far as Nippon India Life is concerned. The red line is where the trender mark was at around 360. The stock has successfully managed to close above that mark. It closed around 366.5 in yesterday's day of trade. And on the back of higher volumes, we've seen this move come in. 3 out of the last 4 trading sessions have been positive for the stock. Yesterday, too, the volumes were 2.4 times the 30-day average. So slowly, we are seeing, volumes also go higher in the stock, and the price has also been moving very quickly in the recent few trading sessions, and that is an indication that we are likely to see the momentum gain, at least for the stock.
All right, how well has this worked in the past, Yash?
Devina, 3 out of the last 5 times that the trender has given a positive indication. On an average over the next 1 month period, the closing returns have been as high as 14%.
Okay, 14%. That's a really good return there. Yash, thanks very much for taking out the time. with that. So that is BQ Bloomberg Edge for you, and we're talking about Nippon Life Asset Management. The other, pocket or spaces that Mayuresh, I want to ask you about is the spaces you'll focus on because of what's happening in China and the coronavirus. And are there any pockets that you feel, I mean, as it may sound, fill the gap that China leaves with regards to demand or production shutdowns or whatever the case may be?
So I think the first sector that comes to point is specialty chemicals. I think we were very, very bullish on this sector for quite a while. I think unfortunate because of the virus, but I think that does open up opportunities, because I think a lot of factories will remain under this shutdown mode for some length of time. Not really sure of what timeline will the authorities follow in terms of controlling this epidemic of sorts. But I think specialty chemicals now probably fall in a very, very sweet spot. There were initial hiccups anyways from China because of environmental issues and supply constraints, which have probably benefited a lot of these specialty chemical players in an Indian context as well. And the second element obviously is that as supply becomes even more scarce, right, I think realizations will start moving higher. So input costs have remained very, very controlled over the past few quarters. So I think it's a natural leverage that a lot of these specialty chemical players can actually exhibit onto their balance sheets. So I think that as a space and niche players within that is something that we continue to like. I think there will be added accelerated earnings reported in Q4.
Which ones? I mean, which chemicals, which companies will be best placed to take the advantage? Any study that, any off the top of the hat answer that you have?
So I think Atul is something that had produced a good set of numbers, and there again I think the value-led volume growth should be quite substantial going forward as well. I think given our call, I think we are already up almost 14-15% in our portfolio.
Does it benefit from the China piece?
Marginally, yes. So I think very few players benefit substantially from Chinese shutdown. So I think a large part in terms of their portfolio itself and the global supply chain, I think these guys can very well cater to that. So I think you've got Atul, you've got to a certain extent Deepak Nitrate. Sudarshan Chemicals, I think, has a decent export portfolio. So I think they are also into the yellow pigment market at this point of time domestically, but they also have a very, very decent export share. So I think Sudarshan Chemicals is one stock can also do well in Q4.
Okay. Watching out for all of those names then. And a few other names that now, you can say have reached critical mass of sorts. Dr. Lal Path Labs, for one, is at 1752 after yesterday's close, was up about 3.5% in a falling market. The day that the markets closed at the lowest point of the day, Dr. Lal Path got gains of about 3.5%. Brijesh, will you trade Dr. Lal Path?
Definitely, from an investment point of view, yes, because if you look at the structure, it has given a bullish head and shoulder, the running head and shoulder, which we generally say in technical pattern, and it is given at a higher level. And yesterday's momentum was very much stronger. So I think looking at the head and shoulder structure, or if I just look at the pole and the flag momentum, the target stands out to be around 2130. So I think at around 1750, I would still get a long bet, keeping a strict stop loss of around 1640 and look for around 2000 to 2100.
What about Metropolis?
I think Metropolis chart is slightly weaker than Dr. Path. I think Dr. Path seems out to be very much better than Metropolis, because if you look at the yesterday's momentum, it has even after opening at the higher level, it has seen a good downside with the volumes. I think I would slightly stay away from Metropolis and look for Lal Path Labs on the better side.
Okay. Hemen, you've been optimistic on pharma. In our conversation yesterday, you maintained that this is the space to be in. Which stocks amongst that path are you optimistic on? And your call specifically on Glenmark as well.
Okay, basically, if you can just give me a couple of minutes, Devina. The Nifty Pharma or the BSE Healthcare moved up from 2009 to 2015. That was around 6 years of a up move bull market. From 2015 to we are in now 2020, so almost another 5 years. Now we are in the process of bottoming out. The longer term mechanical indicators are turning positive, giving crossover buys. So like I said, I think in the next 4 years, maybe roughly 4 to 5 years, pharma should give you 2.53x. My top pick would be, I think there is a stock called Alembic Pharma. I think the retracement has been shallow compared to a Lupin, Glenmark, Aurobindo, Sun. If you look at the foreign pharma, players like Pfizer and Abbott, they have behaved differently. So this does not apply to them. But from the local ones, I believe this is one of the strongest stocks. 5 years of consolidation, setting the stage for a breakout, not a short-term call. We are at 600. I think this should give you 50% return in the next couple of years. Looks fantastic. Turned around, crossover buy, volume highest in this month in the last 3-4 years. Coming back to Glenmark Pharma, it was one of the weaker spots. There's been a huge volume spike, Devina, 2 months back. 14 crores gross. This is not delivery marking, but I believe this 14 crores volume in Glenmark is the highest ever in the history of Glenmark Pharma traded history on National Stock Exchange. So at the lowest point in 5 years, the stock has highest volume ever. So logic is stronger hand the bought, and to sort of reconfirm that line of thought, those levels have held. So I would be positive on Glenmark Pharma, not in the short term. Currently sideways for around 8 weeks, no directional bias. Short term turning positive about 365. Long term, this is going to be a 2x, 3x if you take a 4-year point of view.
4 years, it's a long time, but obviously in the next 8 months, Hemen believes that it's going to remain a flattish play on Glenmark Pharma. We're about 25 seconds left to go for market pre-open, and just looking at Japan is still trading under. So you've got the Nikkei 225, which is under by about 1% right now. For the SGX Nifty, we're down about 0.2%, 24 points given off. We'll see how the larger banks do. Yesterday's session was also, the sell-off was aggravated because of the pain points on both the HDFC Limited and HDFC Bank and Reliance Industries. So 3 big heavyweights, everything contributed to the losses on the downside. That's the pre-open for you. The first sticks are positive on the index at least. Taking a look at the individual stocks and coming back to the index once this settles in. So starting off first with some gainers. Eicher Motors is showing you a 9% pop. We'll wait to see what it settles at. HCL Tech is up about 2.5%. UPL, that's up 2.5%. HDFC Bank has moved up. That's up 1.30%. Bharti Airtel SBI at 320. IndusInd Bank at 1282. M&M, HUL, Wipro, TCS, all trading higher by almost 1%. L&T at 1354 now, that's up 0.5% too. Coming to the losers, Grasim is down 1%, BPCL, Ultratech Cement, Vedanta, Tata Steel. Yesterday, metal saw a big dropping. Today's session, some of that pain continues, but not to that great an extent in terms of the quantum of the cuts. So Tata Steel is still down about 0.5%. Vedanta is down about 0.5%. Hindalco is also down about another 0.5%. And Reliance Industries, that's down to 1,500 now. That's down 1/3%. Coming to the currency, 71.37 is what you've got versus 71.41, I believe, yesterday's close. Not a material change, but still some positive cues on the currency.
Yep, Interglobe Aviation should come up on your screen because of the numbers. Let's see if there is any reaction to that counter. 3.5%. The numbers seemed okay. As Somit had said earlier in first word, that brokerages have by and large, the two brokerages that he's seen had raised the price targets for Interglobe Aviation as well. So let's see if there is indeed that positive reaction on that stock. I think Diwan Housing could have a negative reaction. Kapil Vadan has been arrested, and maybe that stock reacts. For now, 3%. Let's wait and watch. I'm interested in Wockhardt simply because the first sticks are showing that 19% uptick after that 15% uptick yesterday.
Actually, 20% upper circuit.
20% upper circuit yesterday. So don't quite know if this is how it will stay, but it could be an interesting stock to monitor. The other one, of course, Vakrangi, less spoken about it the better, but the stock is active, so just want to point that. And last but not the least, while we're talking about numbers, Navin Fluorine came out with a fairly decent set of numbers. So that's one more name that you should monitor. About 1.5%. It's trading very close to highs. So I don't know what quantum of reaction could come in, but it's an interesting stock to monitor as well. United Spirits, by the way, the numbers looked okay, so watch out for that too. But that's the sum and substance, and we'll try and talk about some of these stocks once the rates stabilize as well. But while we wait for that, and let's get in Sumit Sarkar, who joins in now with the top brokerage calls for the morning. Sumit, good morning yet again.
Good morning, Raj. And the big brokerage call today we have is UBS on the auto sector. Now, the brokerage sees limited scope for a strong rebound for the auto sector, but is turning bullish on the truck companies. Based on the industry tonnage capacity model, likelihood of an industry revival by FY22 is very high according to the brokerage. Along with this, the strategy team expects India growth to surprise positively, and such an earnings inflection is likely to be first visible in the trucking companies, says the brokerage. Also, according to the brokerage, even dedicated freight corridor is unlikely to derail a truck recovery by financial year 2022. Also, a sharper economic rebound could help drive a potential 20% growth in FY21, says the brokerage. Now, on the back of these factors, they have upgraded their ratings on Ashok Leyland and Tata Motors to a buy. And for Ashok Leyland, they have hiked the target price to 106 rupees from 72, and for Tata Motors, they have hiked the target price to 285 from 195. Now, for Tata Motors, the brokerage is also now more confident of JLR margin improvement in financial year 2021 and 2022.
All right, Samit, thanks very much for that. Let's talk about Maruti that's reporting its numbers, and we've got, to watch out for not just the volumes, but also the price hikes that they've been taking. We've already spoken to Mayuresh about it, but let's get in a sense on whether or not any trade is possible on Maruti. Hemen, you want to come in on Maruti or Tata Motors for that matter? I mean, you have a call on Tata Motors.
Tata Motors, I would wait for a day, but I would be long than short. We're at 182. Closer to 178, 176 would be a long call for me, Devina. I believe it could go down for a couple of days. The logic, 177 is a 55-day exponential, and we've broken 184 after 2 weeks. So some more weakness, but closer to Thursday, and 176 would be a buy.
I wonder though, with the China issue, fundamentally, wouldn't it take longer for Tata Motors to be able to recover from and get back, because China is a large market for JLR in that sense, and therefore if there are issues around it, and I think there's a chart that showed that during the SARS outbreak how China not only had a market impact but an economic impact which was telling, and if that is indeed the case, wouldn't it take longer than normal for Tata Motors to revert back to normalcy? While UBS would have thought this through, I just wonder if tactically this is a good time, even if you're bullish on Tata Motors, to buy it, or would you hang on for a bit?
No, I'll wait. I mean, and you're absolutely right. I think the reference to the SARS outbreak, right? It took a quarter's pain, not just in terms of in an industry impact. And obviously, I think once an industry impact happens, it hits your GDP, right? So it's a given on that count. So with the exposure that JLR has, and there were initial signs of pickup within the Chinese market, I think that probably just gets deferred a tad bit. So I'll pretty well hold on to my horses. I'll just wait it out. No need to rush.
No need to rush then, maybe. On Tata Motors though, let's wait and watch how this one does. We are waiting the numbers, and that would be an interesting one. The other stock which has done really well today is United Spirits. Now, for a long time now, Mayuresh, the stock has, the company's lost market share. The prices have stayed subdued. We haven't seen United Spirits move out from this 600, 625 to about 550, 525 range. The numbers look okay. Is a quarter's set of numbers good enough for you to go out and take exposure to the largest spirits maker in the country?
So I think it's lifting our spirits in the middle of the week, right? So to that extent, again, I think the entire premise for all these players is how the volume growth happens, right? And if you stack up all the players within this space itself, I think the entire premiumization portfolio, I think, has taken precedence over the last few quarters. So I think the price hikes that they've probably taken over the past few quarters, the access to the UP market, and though I think a few markets might still get riddled in terms of government uncertainty, I think the volume-led price growth, specifically because of their high portfolio, the premium products that they're having, and the high kitty in the overall share of top line, supports them. I think the only issue that I probably see is the input costs, because both the glass prices and ENA prices have moved up substantially. If the government is really serious in terms of ethanol blending, which it is, right, I think ENA prices will still keep on inching higher. So unless they have the opportunity to hike price, which is taken in cognizance with the state authorities, I think they probably might just take a hit on the operating front. So yeah, I think a decent set of number might take your spirits high for the day.
Okay. I want to also look at AU Small Finance Bank, Ujjivan and Equitas. I mean, these are the names that you need to, keep in mind. AU has reported numbers. Ujjivan has reported numbers. AU ran up post numbers. Ujjivan also had a decent quarter. Still waiting for what Equitas does. But ahead of that, Brijesh, any call on any of these small finance bank, and what's your take on Equitas?
I think I would take a long bet on Ujjivan, because if you look at the structure, it was quite consolidating in a form of triangle formation. If you look at the Ujjivan, after making up around 360-65, We have seen 360, 330 band for quite some time, and we have seen a strong momentum post-result, or if you look at the last 3-4 days of momentum. So I think I stay long on the pennant breakout on OG1 and look for the targets of around 415 on the upside, because if you look at the poll, it has rallied from around 270, 80 to right from around 350. And if I just connect this 70, 80 points from 320, it's targets coming around 410, 415. Coming on to the Equitas, I think still Ujjivan seems to be better, and Equitas is struggling to cross its 200 days average. It has tried 3-4 times previously, but I will slightly wait if there's a sustainable move about 200 days average or not. And yesterday's close was right at around 200 days average. So a couple of days of momentum about 112, 114. Then I would take a long bet on Equitas.
Okay. That's still more favorable for Ujjivan rather than Equitas. Going to wait it out before taking any call there. We're almost at the end of pre-open, so we've got a positive start, a positive close to the Nifty on the pre-open, 12,148. So can anticipate a positive start when we open up for trade as well. The Nifty Bank is up about 84 odd points too. 30,922 is where we are at. Metals as a pocket now, Mayuresh. Everything has been a bit hazy since the last few days, since the China issue was propped up. Do you feel that, however, prices domestically are increasing and they're inching up? Do you see any material change for companies like Hindalco, JSW Steel, Tata Steel, Nalco? Nalco, I think, was a negative call this morning on the technicals, but fundamentally, how do you view ferrous, non-ferrous?
So I think if you look at both the aspects of ferrous and non-ferrous, right, I think it's a classical dichotomy. Why I said dichotomy? Because I think the Q3 numbers were relatively soft. So any reported number that you've seen so far, right, the volume growth was quite okay, and in terms of market expectations, but realizations have probably dragged the EBITDA per ton lower on a quarter-on-quarter and a year-on-year basis. But I think the positive sign is that prices have now inched higher. So if you probably head into Q4, and if the presumption is that the virus outbreak probably gets contained, because there again lies the huge issue in terms of China being the largest producer and consumer, and a corresponding reflect happens on the LME pricing, which probably drags lower the overall growth in terms of offsetting of higher volumes. I think they are probably in a sweeter spot because prices have moved up. Both HRC and CRC prices have actually inched higher. So if you take China, ex-China, and the FOB prices in terms of landed costs for Indian players, and the Indian demand expected to hold up, along with input costs actually coming off. So coking coal, iron ore has come off. So I think you've seen a marginal increase happen. But again, because of the virus, I think they're tapering down. So I think the EBITDA per reported ton should improve on a quarter-on-quarter basis. So I think you look at any management commentary that any of these players have come out with, they're all hinting to a fabulous Q4 going forward. So yeah, I think one really needs to monitor how the entire scenario in terms of the coronavirus is panning out. I think once you see signs of that receding, I think Q4 numbers should really hold out for both ferrous and non-ferrous players.
Okay, let's wait and watch what happens to these companies fundamentally as and when this coronavirus issue does settle down. But we are minutes away from market open. Let's tell you all that you need to know to stay ahead in trade today. First up, HDFC's profit jumps almost 4 times due to a one-time fair value gain from the merger of its arm Agrofinance with Bandhan Bank.
Interglobe Aviation's profit more than doubled thanks to better yields and higher passenger growth.
Amongst earnings after market hours, operating margins improved for Navin Fluorine, United Spirits and V2 Retail. On the other hand, Torrent Pharma reported weak results, but they were in line with estimates.
Cholamandalam Investment launches a QIP issue. The floor price of 322.59 per share is a 2% discount to Monday's close.
UBS is turning bullish on truck companies, saying that truck companies may stage a recovery by FY22.
And Maruti will undertake price hikes across models due to input costs increase. India's largest car maker will also report its third quarter numbers today.
Well, watch out for a couple of pockets. I want to get some technical views here. One is the gas stocks, and all of them were active. The other is, of course, what's happening to United Spirits. It's up 4% in trade. Brijesh, I'll come to you first. United Spirits, 599 and counting. Would you trade this one?
No, not really, Neeraj, because we have seen a clear lower high, lower low structure, and it is when we look at the averages, it given the death cross 50 days average has moved below the 200 days average. So I would slightly avoid going longs on United Spirits.
So that's a clear avoid from Brijesh. Hemen, IGL, MGL, Gujarat Gas, all of them were active. Any one of these which looks the strongest?
MGL, but after the current run-up, Neeraj, I don't think so. I have limited data, but MGL from a longer-term point of view.
Okay, for a longer-term point of view. Fundamentally, Mayuresh, close to market open, but these gas distribution companies, do you like them?
So huge run-up. I think the expectation of volume growth is there. If you look at Dharmendra Pradhan's statement a couple of days back, he's clearly hinted that the infrastructure for gas is going to be around 4 lakh crores over the next few years, and to take the market share of gas from 6% to 15%. So there is a huge incentive for players like this. There are entry barriers as well. So anybody who's wanting an alternate trade, and I mentioned that last week as well, I think if gas stocks have run up substantially, I think GSPL, which is the parent of Gujarat Gas, is something that can be played out because valuations still look very, very attractive. And it's also having a pie in terms of a 55% stake in Gujarat Gas. So you're playing both the distribution and the gas, the transmission and the gas distribution business of Gujarat Gas.
Okay. We have about a minute left to go for market open. We'll get our top calls going from our technical experts. Come to you, Brijesh, first. What's the one top call for you in terms of market opening?
I think I will go long on LTI because we have seen IT space again gaining momentum and keeping a target of around 21 and on the upside.
Okay, that's L&T Infotech. What about you, Hemen? What's your top call?
I'd go long on Tata Steel, Devina, as a counter buy call.
Steel it is from Hemen. Gentlemen, stay on. We'll take in opening thoughts from you on the charts in just a bit. Mayuresh, take a moment to thank you, though, for joining in today and giving us your thoughts. Really appreciate your time. All right, the market's slated to start off in the green. Maybe the Indian indices are looking at the Dow futures as opposed to what the Asian screen is doing right now or what the other markets indicated. And maybe crude provides that bit of a benefit as well because US markets were down and out yesterday, about 1.5% to 2%. Asia, whatever is working, which is KOSPI, Australia as well as Nikkei, are down. But we are starting off in the green. Let's see if we hold on. And then let's try and figure out what could happen during the course of the day. But here's how we're starting off. About 0.25% in the green for the Nifty 50 or 0.18%, 0.2% for the Sensex, about 83 points. The Nifty banked to a subdued trade, just about flattish, about 27 odd points. And now moving slowly to break-even points as well. So let's wait and watch if these levels last. The broader end of the spectrum should also come up on your screen. Very, very flat, about 0.25% for the small cap space. That's about it. So it's a flattish start, you would have to say. Maybe a bit more green on the Nifty 50. Let's see if that is indeed the case. No, it's actually almost even Stevens. Hardly any moves. Keep in mind, though, that yesterday's top losers continue to grind lower. So you have Vedanta, JSW Steel, Tata Steel, all of them correcting. Bharti Airtel has corrected a little bit in the session today as well. So do keep that at the back of your mind. But it's almost even Stevens. Save for metals, we don't have too many big gashes on the large cap space. What about gainers? HDFC, a bit of a reaction to the numbers, maybe 1.39% higher. Tata Motors, the brokerage upgrade, maybe playing its part, so up about 1%. SBI is up, BPCL is up, and HDFC Bank, which has corrected quite viciously the last few days, just starts off in the green. Let's wait and watch if this lasts. Maruti too is about 1/3%, but hardly any movers there. HDFC on the upside, metal companies on the downside. That's the story for the morning. A couple of individual pockets. Firstly, stocks which are in focus are Interglobe Aviation because of the results and SpiceJet because of the fall that we've seen in crude, and maybe there is some positivity there. So 2.5% for SpiceJet. Interglobe Aviation very, very flat though, not a big reaction. Maybe the other result reactions would be active, and Devina will speak about that. But just one pocket that I want to highlight in addition to the airline stocks, which is the gas companies, and very active in trade the last few days. MGL, IGL as well, Gujarat Gas, and Gujarat Gas is the one that starts off very positively, about 1.5% higher. Let's see if these gains last. But very flat on the large caps. Devina, what about the broader end of the spectrum?
Well, you've highlighted a few in terms of the earnings performance, Indigo particularly. I'll talk about the others that reported numbers. Navin Fluorine, margins came in higher on the back of lower raw material costs. EBITDA was up 26%. Stocks opened up positive, about 2% higher this morning. Torrent Pharma is the other one. Results were in line with expectations, but the core performance remained weak. The stock is opened lower by about 3% United Spirits, and that is up about 4.8% Margins improved due to lower costs and other expenses as well. There's been a volume recovery in the premium segment too for United Spirits, so it's up about 4.5%. Other stocks, Walcott continues to do well. Yesterday was locked up in upper circuit. Today is up another 5% in early morning trade. You've got VRL Logistics, which is up 4% too. Bakrangi, remember, not a fundamental call, but it was a trading call given by Rahul Mohinder just a few days ago, and since then it's moved up. It's at 55 right now, 3.5% higher. Karnataka Bank, 2.88% higher. You've got CCL Products, 3% higher. Astro Poly, which is up 2.5%. Dish TV is moved up too. MTNL, 2% higher. All Cargo Logistics up about 2%. Alembic Pharma, Shipping Corp, Vinity Organics, Vodafone are up about 1 to 1.5% apiece. What's losing? PTC India Financials is down about 5.5%. Torrent Pharma, we spoke about that one. Quest Corp's down 2%. Radico Khaitan, Strides Pharma, JSW Steel, some of the other bigger losers in trade this morning. But it's more bent towards the positive side. The breadth of the market is positive. 838 stocks advanced as opposed to a decline of 303 stocks.
Brijesh, you had a negative call on the index. It started off just about flat. Good time to take in that short call on the Nifty or the Nifty Bank?
Yeah, definitely, Neeraj. I will look for a Bank Nifty short 30,920, keeping a stop loss of 31,089, and look for downside around 30,500, 30,300 on the downside.
Hemen, while you've given us your top call, it's just about 3-4 minutes that the markets have started. Anything that stands out on the screen?
I think HUL seems weak. I think that's where pressure should come in. So I would probably have a short on FMCG, especially HUL, Neeraj, from an intraday point of view.
Okay, we leave it at that, gentlemen. Brijesh as well as Hemen, thank you so much for joining us this morning. Let's also welcome in Pramod Gubbi of Marcellus Investment Managers joining us on the show this morning. Pramod, thanks very much for taking the time and speaking with us. Let's talk about the big event over the weekend, the budget. At Marcellus, is there anything specific that you're going to be watching out from the speech?
No, of course, we wouldn't want to be in the position of the government. It's really a tough task to manage.
Stuck in a hard place.
In between a rock and a hard place.
Yeah.
So you need to stimulate the economy, but you don't have too many tools to do that. So it'll take some ingenuity on part of the government to achieve that goal. But I think at the margin, we would like to see more of a credible budget, where there is belief on the numbers, whatever it is that the government comes up with, particularly in terms of assumptions around taxation. Clearly, in the recent past, we've seen some of those numbers not panning out the way. But in terms of the biggest source where they can, I think it's perhaps the best opportunity to push through disinvestment more aggressively, because you can't really afford to have too much of tax increases to fund the fiscal deficit. At the same time, you have to stimulate. So perhaps something that we've been delaying for so long, need to take a more aggressive stance in terms of privatization and using that as a source of revenue to stimulate the economy. On the other hand, I think anything around tax cuts for the bottom of the pyramid will help. Thankfully, we are seeing some pickup in the rural economy, which can be further boosted. Other than that, I think if you see a credible number around the fiscal deficit, something around 4%, with the assumptions around tax growth and expenditure fairly reasonable, I think the market will take that.
Okay. The other question is, a budget which doesn't tinker too much with the fisc number, and in turn doesn't stimulate the economy too much, because there's an equal side of the camp which is saying that this is a natural move that is happening. Don't try and tinker around with too much, because it will take its own sweet time. And the fact that there are enough and more people who are debating whether, if there is a fisc slippage, it should happen towards the consumption, it should aid consumption, whether that expenditure should aid investment, is also divided. So if nothing happens, will that be viewed as a negative, or do you think the markets will digest it because of the flows?
Yeah, well, like I said, even if nothing happens, as long as the deficit number that's presented is credible and can be understood in terms of the assumptions underlying both the taxation growth and the expenditure, I don't think it'll be that much of a negative reaction. If you manage to come out with some clever ways to squeeze out some sort of stimulus, it's even better. But I think if we slip up on, or if we come out with unrealistic expectations in terms of tax revenue growth, that could actually be
Okay, so let me ask a counter question. If there is some tinkering with the personal tax, what within the consumption basket would you believe fundamentally could benefit over the next 12 months? Because, I mean, there's somebody who put out this message as well, right? And it's logical. Just because there is more money in the hands, presumably if there is, people are not going to go out and brush thrice. Right. So it's not that those consumption items would pick up, but you would have dissected this in a lot more granular fashion. What will benefit fundamentally?
Well, I mean, I think it would still be the low-ticket items. It is something more which is staples and essential. Like I said, we are already seeing some pickup in the rural economy thanks to the, food price inflation, where you're transferring the consumption from the urban class to the rural class. Alongside that, if you offer some sort of a stimulus to the bottom of the pyramid through those tax, at least the sort of slowdown that we're seeing in consumption growth itself can be arrested. I'm not saying it'll be boosted, but at least that sort of slowdown will stop contributing to the overall slowdown in the economy. So I would reckon that's still a better choice because investment, of course, investment growth will be part of long-term reforms, whether it's infrastructure or real estate. Both can have a significant multiplier effect, but you may not see immediate benefits of it. Again, yet another tough trade-off for the government, whether to boost consumption or investment. In the long run, of course, the investment cycle is better, but in the short term, the government needs to arrest the slowdown. So again, not a question I would like to answer from the government's perspective.
So, we spoke to Mr. Parthasarathy of Hemen just a few days back, and he said that the government is under stress. So it would probably work well if it was a more inclusive budget where you share the burden. It's not upon the government to make sure that they can go whole hog with all the expenditures while keeping the fiscal deficit in check. It's up to the industry, the corporate world, to also pitch in and make sure that they start and churn out the increasing capacity, making private sector investments, and making sure that they are aligned with the capex targets as well. Right. Do you think that that's something that the industry is positioned to do right now? Are they capable to do it?
Well, I mean, they're capable, of course, but you'd have to leave it to free market forces to play out. Of course, industry wants to grow profits, want to grow their business. If they see a long-term trajectory in terms of demand picking up, they will put up capacity. There's no doubt about it. At this stage, I think barring a few industries, utilizations are still not there that you have to rush to put up new capacity. So the key is to stimulate demand, give the confidence to the industry that demand is picking up, and then I'm pretty sure industry will not have a problem in terms of putting up that capacity. So I don't think you can impose this upon the corporate sector. You have to facilitate the economic environment which can be conducive for capex activity from a private sector perspective. Until such time, the government has to hold the baton. But I think there is another component which is, besides the union government, which is the state governments. Clearly, the state government's fiscal deficit, I think Dr. Ratin Roy put out a piece recently which suggested the state governments are in a relatively better shape as far as the fiscal position is concerned. This is at an aggregate level. Of course, there are states which are in distress and there are states which are in relatively surplus situation. In fact, the states can contribute to taking some of the slack from the union government in terms of stimulating the economy. And states have a better record in terms of investing in capex as opposed to the central government. So other than the corporate world, I think you also need to look at the state government budgets to see if there's any stimulus coming from there as well.
Any specific industries, for example, auto, do you expect anything to come about on the scrappage policy? For real estate, obviously the working of the AIF fund that has been announced and how the status of that is moving versus, say, for example, the rental income, tax on rental income and the scope of that being increased. That could be something that could help the real estate space, and infrastructure spending and how does that help? So individual pockets, any expectations?
Right. No, I think real estate is clearly should be the focus because we've seen it having a significant multiplier effect. And given that real estate slowdown has contributed to a lot of the present situation, it does deserve some special attention from the government, particularly if we can look at some cuts in GST on that. It's not permanent, but a temporary boost around stimulating demand or a relief to the sector can go a long way in terms of both creating jobs and boosting consumption at the end of the day, and also triggering a capex cycle. Remember, real estate has been a big driver of capex in the economy historically, and that's something that the government can look to boost. Other than that, I think infrastructure has been the focus of the government. It's not like they're going to change something from the recent past. So I would say if there's one sector you would pick out, it has to be housing.
It's a far-fetched thought, but anything that you think can come about for the capital markets?
Well, I think reversal of the LTCG or perhaps a change in the LTCG structure to increasing the tenure, where you're saying perhaps the 10% is 2 to 3 years, and beyond that it's 0% could be a boost. Dividend distribution tax again could be, because dividends are now heavily taxed, which is skewing things in favor of buybacks. So anything around that can be a boost.
But they recently announced it. What makes you? I mean.
Well, I guess. To
announce a measure and then to just reverse back on it.
No, we did the surcharge, right? So the surcharge was announced in June and reversed in August, September. So there's no harm if you reckon that it's the right thing for the capital markets and the economy. It's worth looking for it. Clearly, it's on the anvil. Not sure if it will actually transpire that way.
Okay. Unless I'm wrong, you guys are launching a small cap fund. Okay. Now my question is with regards to that. For all of 2019, you, Saurabh, Rakshit, have been at the forefront saying that large cap stroke quality will succeed. Not necessarily large cap, but quality names, and doesn't matter what happens to premium valuations. The last 1 month has seen a bit of a reversion. Not that the high quality names have come off, but there has been a substantial uptick in some of the others which were not quite considered in 2019 by most people.
Yeah.
Would your investment hypothesis for a small cap fund be different from that, in that you would look at value or growth at very reasonable price as opposed to paying a premium for visible growth?
Well, yes, no, I don't think we can completely change our investment philosophy. So, we will have to look at it from a consistent perspective. So one thing we'd like to focus on is quality, whether the quality exists in whichever market cap spectrum. We don't really care that much. Remember, we're looking for dominant franchises in their respective industries. Now, if the industry happens to be a niche industry, even if you're a dominant franchise, you could end up being in the small cap bucket. So for our small cap funds, we're still looking for franchises which are market leaders in their respective industry, not necessarily a challenger or a trailing company in a large industry. To that extent,
give us a few examples.
It could be a small, equipment manufacturer for a chemicals industry, for example, right? So where the demand is consistent, and as you know, with the shift in demand from China to India, there is capex activity happening in that sector. So even over the last 2 years, the sector has continuously delivered earnings growth. There is demand for equipment. But it's not a large sector, so you're perhaps the one of two providers of that equipment to that industry, and between the two of you, you pretty much run a duopoly. Similarly, auto ancillaries, there could be some components where you're the majority supplier to the four-wheeler sector, right? And the four-wheeler sector itself is consolidated. It's not like there are too many players around. So the component itself may not be a large part of the entire automobile cost, but within that component, there are just 1 or 2 players, and you're perhaps the dominant guy. So like that, there could be some ancillary industries where there are still dominant franchises. Because the industry is niche, you're a small cap company. Having said that, I think given the very nature of small caps as an asset class, which is extremely volatile compared to large caps, even if we were to pick out the highest quality names in that, you will have to take a slightly different look in terms of valuations, because unlike our consistent compounders, where the intention is to buy where we never want to sell ideally, unless of course our assumptions change. Here, given the volatility, you will have to take some profits. Given the intention to take some profits at some stage, you would want to be cognizant of the entry-level valuations, not in terms of price to earnings or so on, but we would want a significantly higher margin of safety, as opposed to the consistent compounders, where the conviction of these companies growing for the next 10, 20 years is fairly high, given the sort of franchise strength. Sure. The small caps still have a lot to prove, and hence there will be a slight difference in approach.
Okay. A pocket which is small cap but has really done well. I wonder, what do you think about back-end manufacturing? We've had Dixon and Amber Enterprises do well. Even in the non-electronic space, is a Hindustan Foods which does this back-end and has done exceptionally well for itself. So these are no longer cheap companies, but they are virtually duopolies or monopolies in certain sense, yeah, at least in the listed space. Do you like these? Do you like this theme?
We don't work on a thematic basis. We do bottom up. But I would tend to agree because in a difficult manufacturing environment, if somebody's managed to put up a successful franchise catering it to some of the largest brands, some of these brands they cater to are global brands, and if they have chosen these companies to supply to them, clearly they tick a lot of boxes. And there aren't too many of them. Like you said, it's again ideally placed because there are 1 or 2 or 3 companies in each product category, which again nicely sets itself up for a monopolistic or a duopolistic situation, which means that you tend to garner most of the profits, except in this case you're not catering to the consumer directly. So your customer is also a consolidated lot, and hence you don't necessarily have the same sort of bargaining power that you would have if you were a B2C franchise.
Okay, at least one final question from my end. What is it that you guys like the most currently? Some of the high quality financials have taken a bit of a backseat, 7, 8, 9% kind of a fall in the last few days. Do you veer out there because the valuations are maybe a bit more reasonable than what they were a month ago? I'm not saying you necessarily use, this is your investment philosophy, but maybe you could tactically use this as advantages. What do you like the most?
Well, I mean, nothing's changed from our perspective. Like I said, if these stocks had rallied another 10%, we would still be buying because we still believe that they're significantly below their intrinsic value. But I think it is a reminder of sorts that given the state of the economy, even the best of franchises can take a knock, both in terms of growth and asset quality. I don't think anybody can escape or become totally immune to these forces, which is what is being played out. But I think we would tend to look at it from a longer term perspective. 1 or 2 quarters, we are happy to look through these changes. But yes, it is a reminder nonetheless that the economy is hurting even the best of companies.
I just want to squeeze in one question. You spoke about having a niche, probably 1 or 2 listed players, exhibition as a space. You have PVR and Inox.
Right.
What would you do there?
Well, there are some good companies there. We're wary about the asset-heavy nature of those industries. To fund growth, you need to put up more capex. Currently, the operating cash flows perhaps just about there to fund future capex. So it's not a heavily free cash flow generating sector, and we would prefer to see much free cash flow, and hence we're wary of that. Plus, there could be potential disruption around OTT and so on. We're not sure if that's likely to play out. Remember, in our country, we don't have too many opportunities from a recreation perspective. So some of these, screening theaters remain the default option for most families in the country. So while we're wary of that, the bigger deterrent for us is the capex-heavy nature of these industries.
Okay, got that. Pramod, thank you so very much for joining us this morning. Pramod Gubbi there of Marcellus Investment Managers. We're going to take a very short break. The markets are holding steady ground, about 0.25% higher on the Nifty.
Yep, coming up, we discuss GMM Pfaudler's earnings with Managing Director Tarak Patel.